now we're going to talk about the very last part of our separately reported items, which deal with accounting changes. Now, in terms of for your tests or your exams or your problems, I won't really focus that much on accounting changes. I would dare not require you guys to calculate the accounting changes, but I at least want you guys to be aware and need to know the rules of accounting changes. So you will may be assessed on the rules of accounting changes, so make sure that you are able to identify, okay? And so basically there are three types of accounting changes. You have change in principle. We have change in estimate. And you still have change in entity. The one that we're really going to focus on are the first two. The change in principle and the change in estimate. Okay? And so, before we talk about the rules, I want you to understand that your accounting changes, just like your separately reported items, just like your discontinued operation items, must always be reported net of its tax effect. So right after you throw the numbers down there, you have to show its tax effect, okay? And so let's talk about that accounting change in principle. Understand that the change in principle could come in two formats. It could either be voluntary or involuntary. Okay? Voluntary or involuntary. So what are we talking about a change in accounting principle? We have certain principles that we pretty much utilize in accounting. And it shows us how to properly record or report information, and sometimes we change from them. The most frequent example that is like to be tossed around will be your inventory costing method. So let's say we decided to go from FIFO and we changed to LIFO. Well, that's a change in principle, okay? And so basically any change in principle that you make normally in some form or fashion will affect income. Let's keep it an example of the inventory costing methods. When you change from FIFO to LIFO, it more than likely will change the cost of your ending inventory, which goes on your balance sheet because it's an asset, but it will also change the cost of your goods sold. Your cost of goods sold, which is an expense, which goes on the income statement, which affects income. So anytime that you change from that principle, you ultimately may affect the income that's generated from that, which goes on the income statement. And so that's where we would report that, okay? And so, again, you have two different types of categories. You could have a voluntary change in principle. So we would say, as companies management, that we decided to change from FIFO to LIFO, right? Or you could have an involuntary change, which basically is when you're forced through some type of new accounting pronouncement or something that requires you to have to make that change from FIFO to LIFO, okay? And so let's handle the voluntary change first.